Welcome to lesson 1 of options trading for beginners. Today we are kicking it off with the basics, and that is what are options, why they're powerful, and yes, how you can profit without ever actually hitting a strike price. By the end of this, you should understand the foundations of options and why so many traders love them. Here's the deal. An option is simply a contract. It's like a ticket that gives you the right, but not the obligation, to buy or sell a stock at a certain price, called the strike price, before a specific expiration date. And get this, each option contract controls 100 shares of stock. This gives you a lot of leverage, allowing you to control a bigger position without having to own the stock. Now let's be real, buying or selling 100 shares takes capital, and that's why many traders do not exercise the option. Instead, they simply trade the option itself, buying and selling the contract as the price changes. It's a smart way to trade without needing massive capital up front. We're going to talk types of options, and the two main types are calls and puts. A call option gives you the right to buy the stock at the strike price, which is great if you think the stock's going to go up. For instance, let's say stock is trading at $100 and you buy a call with a strike price of $110. You're betting it will go above $110. If it does, you could buy at $110 and potentially flip it for a profit. But remember, you don't have to. You could simply sell the option contract itself for a higher price. Now, on the flip side, we have put options. And for a put option, you are getting the right to sell the stock at a strike price when it's below the stock's current price. So for example, if the stock's at $100 and you buy a put with a strike price of 90, you can make money if the stock dips below 90. Again, you can sell the contract itself without ever touching the stock. This is where options get exciting. You don't actually have to reach the strike price to make money. Options have their own prices called premiums, and those premiums change all the time. This lets you buy low, sell high, and profit off the option itself. Let's say you buy a call option when the stock's at $100 and the premium is $5. If the stock rises a bit, that premium might go to $8. You can sell that option and cash in even though your stock never hit your call strike price. Many traders focus on this approach, buying and selling the options contracts without ever actually buying the stock. It's about profiting off the movement and trading the options. This is where it gets really powerful with options trading. Options prices are affected by some factors known as delta, gamma, theta, and vega, the Greeks. These are like little levers that can change an option's price. Delta tells you how much the options price will move for every $1 change in the stock price. The higher the delta, the more the option moves with a stock. Gamma is delta sidekick. It shows you how fast delta is changing. Gamma helps us understand how volatile an option can be as the stock price changes. Theta is all about time. Every day an option loses a bit of value, which we call time decay. Theta is important because options lose value as they get closer to expiration. Vega represents volatility. When the market gets jumpy, Vega increases, and so do the options premium. Understanding the Greeks can help you predict how an options price will change. It's like having a cheat sheet for the market. And this is just a heads up, options don't always win. They can expire worthless. If the stock doesn't move in your favor by expiration, your option could be worth zero and you'd lose the premium you paid. This is why timing is critical. You want to be aware of both the price movement and the time left until expiration. Being strategic about timing is what separates successful traders from the rest. It's about understanding the Greeks, watching the stock market, and knowing when to get in or out. We're going to go through a quick recap. An option is a contract that gives you the right but not the obligation to buy or sell. A premium is the price you pay for the option you choose. The strike price, the price at which you can buy or sell the stock. Expiration date, the last day the option is valid. Call option gives the right to buy a stock. Put option, the right to sell a stock. And we have 100 shares per contract. The Greeks are delta, gamma, theta, and vega. And that's it for lesson 1. We've got the basics on options, the types of contracts, and a quick intro to the Greeks. And remember, with options, you don't need to hit the strike price to profit. Trading the contracts can be just as powerful. In our next lesson, we'll dive deeper into how these prices change and what influences options value with real life examples. If you found this helpful, give it a like, a subscribe, and hit that bell icon to stay tuned for the next lesson. Got questions? Drop them in the comments below. Thanks for watching, and I will see you in the next video.